Hi, Sebastian here from Wealth Depot. Just thought it'd be a great opportunity to provide some question and answers to some of the key money matters that are surrounding us during these uncertain times. A lot of our clients obviously are facing particular strains and pressures on their financial situation, and we thought it would be definitely timely to provide some updates and some information that might help just to relieve any of those pressures or uncertainties. So with also the COVID-19 virus impacting us not just here in Australia but globally, um, you know, income streams, where we're going to find money to pay, ongoing bills are starting to creep up on a lot of our clients, and obviously, no one is immune to that over the next few months. So clients that are all in different situations, be it casual, full-time, self-employed, or retirees. We're all facing some uncertainty, and I hope that today's little presentation will just answer some of those questions. But obviously, if we don't get to answer all your questions, please don't hesitate to obviously email us or call us, and I'll be happy to have a look at your own personal situation and provide some answers around that. So, access to super is probably one of the key areas that obviously we can help with around accessing some financial support over the next few months or what may be. So access to super when you're not retired is available under the condition of release rules under certain circumstances. So early release can be through severe financial hardship, specified compassionate grounds, or reaching a preservation age and starting a transition to retirement income pension. So access under these rules are all specific and require a little bit of planning and understanding and application. But also, if you do meet your preservation age, you can access obviously your superannuation at any time. And if obviously you're retired, you have what we call a nil restriction basis, so that way you can draw down the minimum pension, or you can draw down as much as you need to continue to support you and your family. Obviously, when you reach 65, access to super is allowed completely, whether you start a pension or not. And if you are permanently disabled or even temporarily have a temporary capacity, access to super is available, but only under certain circumstances and with medical evidence. And not all super funds provide all conditions of release. So checking with super fund first is important. And obviously, if you are terminally ill, then access to super is also allowed. But one thing to be aware of is that if you lose your job, it doesn't mean you've met a condition of release. So you may not be able to access your super just purely based on that criteria. How do you access your super based on under the financial hardship condition of release? Well, accessing super early under financial hardship means that you need to be in continuous receipt of an income support payment from Centrelink or Department of Veterans Affairs for a minimum of 26 weeks, or up to 39 weeks, if you've reached your preservation age. So these can commonly be disability support pension, New Start, or carer payment. And who determines if you're eligible or not? Well, that does again come down to your super fund. So if you're aged less than your preservation age, your super fund will need to determine you've been unable to meet immediate family living expenses. And this will be considered on a case-by-case basis by the fund. But these immediate family living expenses can include groceries, utilities, medical bills, and education costs. So it provides definitely a far-reaching ability to cover general expenses that we face every day. If you're over your preservation age, the only condition is that you're not working and meet the 39-week requirement. So you also will need written confirmation from Centrelink or the Department of Veterans Affairs that you're receiving the income support payment. So after you determine that you are eligible to withdraw superannuation under the financial hardship condition of release, there are also some other considerations that need to be taken into account. One of those is tax, and will you have to pay tax on any amount withdrawn? So depending on your age, you may have to pay tax on amounts paid to you from super. Where you withdraw a lump sum, your super provider will withhold the tax on your behalf if your payment is taxable. If you're age 60 and over and your super fund isn't an untaxed fund, you won't have to pay any tax on any withdrawals. However, if you're under 60, you may have to pay tax at up to 22% on some of the amount you withdraw. If you've reached your preservation age, you may be exempt from paying tax on some of those amounts. And if you're receiving any other government benefits or concessions, or you hold a government concession card, it's important to check how a payment from super could impact your entitlement under the asset and income tests that are relevant. So now let's look at how you can access super under the compassionate ground condition of release. If you have certain unpaid expenses that you can't meet, you may be eligible to access some of your super savings. However, there are specific circumstances that will qualify you to make a withdrawal under this rule. Also, the amount that you're able to withdraw is based on the types and amount of expenses you're unable to meet. So eligible expenses may include payment of medical expenses for either you or a dependent associated with a life-threatening illness or injury, pain or mental illness, home loan repayments when you're threatened with repossession by your lender, modifications to your home that you need to make because of severe disability, and funeral expenses if you lose a dependent. Other rules and eligibility criteria may also apply. But how do you first apply for a release? First of all, you'll need to check with your super provider that you will release your funds if you will meet the compassionate grounds criteria. Again, not all super funds may provide for this, and you must check with your provider. Then you'll need to apply to the ATO directly, and the application can be done online. Appropriate evidence is also required to allow the ATO to make an assessment of your circumstances. This could be doctor's reports, quotes, invoice bills, or proof of dependency. The ATO indicates that assessment of your eligibility may take up to 14 days. However, this may increase at peak times. So if the ATO determines that you're eligible, they will contact you or your super fund directly, and you'll then need to get in touch with your super fund to arrange your withdrawal. Obviously, we're most happy to help with that process and to provide that assistance. You'll only be eligible to make one lump sum withdrawal as determined by the ATO, and you'll need to keep your receipts as evidence once you've been paid the expense. It is important to understand that if you've already paid the expense, even using a credit card or borrow funds, you won't be eligible to apply to access your super on compassionate grounds, as it only relates to unpaid expenses. So now we focus on the others condition of release, namely the account-based pension, or more commonly known as the pension from super. So super rules require you to withdraw a minimum amount from an account-based pension each year. This amount is based on your age and pension balance at the beginning of each financial year, or the date you start your pension if you start it partway through the year. If you've already received total income payments from your pension this financial year, they're at least equal to this minimum amount. You can also ask your fund not to pay you any additional pension payments for the year. You could also decide to stop your pension altogether by switching your pension back to an accumulation account, but your super fund will make sure you receive at least the annual minimum before you do. During the GFC, the government reduced the minimum drawdown rates because of a significant decrease in account balances. This helped some people to retain more in their super funds and to wait for the market to recover. We don't know yet whether a similar change or announcement will be made as a result of recent events, but obviously we'll continue to keep you updated. If you continue your account-based pension, your new minimum pension payment for next financial year will be based on your account balance on 1 July 2020, which may be significantly lower than anticipated. This may mean you need to adjust your annual pension payment to ensure your cash flow needs are met. This is an important part of us as your advisor, helping you to manage your cash flow going forward. So please talk to us and we'll definitely help to navigate. Okay, so now let's just turn our attention to some other maybe concerns with our clients regarding accessing super if you're a temporary resident of Australia. As some of you may know, we're involved with the Italian community, with the consulate of Italian consulate and the government elected body called comites, and so we do a little bit of work in this space with our Italian clients, but generally we've also helped other non-Italian clients also access their super once they have returned to their home country after departing Australia. In a sense, if you've worked or earned super while visiting Australia, you can apply to have the super paid to you as a departing Australian superannuation payment only after you leave though, and you must submit an application to either the super fund or the ATO depending on how long you have departed Australia. So if it's been 6 months or more that your visa has been ceased, or in effect you've not claimed your DSP, your super fund will transfer your super money to the ATO as unclaimed super money, and then subsequently can be claimed from the ATO direct. Generally, the DSP will be paid within 28 days of receipt of the completed application and may be paid to an Australian bank account, most likely, check or international money transfer. Generally, we've seen it only paid to an Australian bank account, so that's important not to cancel your bank account in Australia until this process is complete. The final DSP, a final DSP tax will be held from the payment, and this could be up to 35% of the payment. You'll be issued a DSP payment summary from the fund within 14 days of making the payment, and this payment summary will detail the amount of DSP tax that was withheld and then amount issued to you. If you are a New Zealand citizen living in Australia permanently, you may be able to transfer your super to New Zealand under the Train Tasman Retirement Savings Portability Scheme for individuals. So just keep that in mind if it's relevant. So some other obviously questions that might be raised during these times of uncertainty regarding employment and job security for clients that may be offered redundancy and how those should be structured. Again, we're here to help, so please reach out and also let us know what's happening in your circumstance, and we can develop those strategies appropriate to you and to hopefully provide the best outcome or the best outcome possible. So, can I contribute any redundancy payments to super? Well, any contributions you make will be under the ordinary contribution caps. However, before you do this, it's important to remember that once you contribute funds to super, you'll need to meet a conditional release before you can access the funds again. Therefore, before you do make a contribution, it's important to make sure you've set aside enough to access in the meantime until you decide on your next steps. So, if you have been made redundant, can you apply to receive a social security benefit? You may be entitled to a social security benefit or concession card, but the benefit or concession you're entitled to will depend on your circumstances. But this could include Jobseeker payment, which now replaces the New Start allowance and sickness allowance from 20th March 2020, youth allowance, or parenting payment. Where your claim is related to COVID-19, some eligibility requirements that relate to these payments could be waived. So let's have a quick deep dive into what these payments and concession cards actually provide. So the Jobseeker payment, right, is available to you if you're aged between 22 and the age pension age, and you meet certain eligibility criteria. The amount that you're entitled to receive will also vary depending on your income and assets. You may also need to satisfy certain waiting periods before your payment commences, including a liquid asset waiting period, which varies depending on the value of cash and other accessible funds available to you, and an income maintenance waiting period related to any redundancy or other termination payments received. The government has confirmed that the ordinary waiting period of 1 week will be waived where you're claiming because you've been affected by COVID-19. Job seekers who are affected by COVID-19 may be granted a major personal crisis exemption for 14 days, which means if you're impacted, you may not be required to actively seek employment or complete approved volunteer working during this period. The government may make further announcements in relation to changes to waiting periods, payment rates or thresholds in response to current events. The low-income health card provides certain benefits such as cheaper medicines under the pharmaceutical benefit scheme and concessions for utility bills. However, the low-income health card is income tested. So what if the value of your investments have reduced as a result of negative market movements? Should you tell Centrelink and DVA? Most income and assets are assessed to determine your entitlement to income support, such as the age pension, service pension, and Jobseeker. Ordinarily, Centrelink or DVA automatically revalue many of your assets without you even knowing or needing to do anything. This is achieved through reporting from certain providers, such as super funds and managed fund trustees, and readily available market information, such as property valuations. Financial investments such as bank account, term deposits, managed funds, direct shares, and super, if you're over pension age, are automatically revalued in March and September each year. This aligns to the increase in the reassessment for income support recipients on 20th of March and 20th of September using the latest market values at that time. Income streams such as account-based pensions are revalued in February and August based on information received directly from the super fund. If your income stream is paid from your self-managed super fund, this is valued in February only. Other assets such as property investment, which don't have a readily available market value, are based on information provided by you, or the department may seek a valuation at its own expense. It is expected that revaluation of financial investments will be captured on 20th of March. However, income streams are revalued in February, and these values would not capture the more recent market falls. So where the value of assets may not capture current values or possible further market falls, you have the option to request the department to do a revaluation of your assets to determine your entitlement. If this is requested, all your assets are revalued and your entitlement redetermined. Also remember that you should notify the relevant department in 14 days if there are any changes in your circumstances that would impact your entitlement. This could include personal financial changes, including changing your relationship status, making lump sum withdrawals from super or income streams, or selling or redeeming shares or managed funds. By ensuring you have the correct value recorded with the department, you can ensure you're receiving the correct entitlement. If you're also in residential aged care, this may also change the ongoing fees you need to pay. If you have paid a lump sum accommodation payment or bond to an aged care facility, with all that's happening in the economy, do you need to be concerned about recovering this amount? Lump sum accommodation payments or bond balances paid to a government subsidised aged care facility are effectively guaranteed by the government. If the facility becomes bankrupt or insolvent, the balance of your lump sum will be repaid to you or your estate by the government. If you've agreed with your facility to have ongoing fees and other expenses deducted from your bond or deposit, this will reduce the amount you've paid to you by the government. Does my life and sickness insurance policy cover COVID-19 and other pandemics? This will vary from one policy to another, and you need to check your policy and your super fund to confirm if you're covered. Most life insurance policies generally cover pandemics. Some policies provided through employer or industry corporate super funds may have pandemic exclusions. It's usually when death or total and permanent disability or an illness related to a pandemic occurs shortly after cover commences, that is within 30 days. Beyond this, most policies will pay in the event that a death, disability, or illness results from a pandemic and where all other policy conditions are met. If you have any concerns around this, or you may need to make a claim, please reach out, talk to us. We're here to help you through that claim process. It's one of our vital roles and services that we provide. If I can't work because I have been diagnosed with COVID-19 or I am required to self-isolate, can I claim on my income protection policy? As most people who have been diagnosed with COVID-19 have recovered quite quickly, you may not be able to claim on your income protection policy. This is because you need to be disabled, as defined in the policy, for the duration of the waiting period, which can be as short as 14 days, but is most likely to be between 30 and 90 days. Also, if you're receiving sick leave or other special leave payments from your employer during this time, you may not be eligible to receive additional payments from an income protection policy held in super. So we're here to help, and that's the message I would like for you to take away definitely today. If you need help to understand any of the discussing points and strategies I recently just spoke about today, please reach out. We're here to help and help provide financial support in times such as these. So in addition to that, please, if you have family or friends that are seeking answers but may not have an advisor that they do connect with regularly, ask them to contact us. We're happy to provide them a no obligation, free chat just to discuss their current situation and to provide maybe some insights, some ideas that they could consider. And we would appreciate that in any case. So stay well, stay healthy, and we'll be providing further updates over the course of the coming days, weeks, and months. And also, if you have any questions directly related to your circumstance, please reach out and let us know by email, by phone, and we'll be happy to set up a phone consultation or video conference as soon as possible. Thank you and take care.